Hey everybody, good afternoon. It's Lewis here, and we're back for another edition of our 3 and 3 research offering where we outline important things we're watching the market in 3 minutes. Here we go. So we're talking today about the euro-dollar curve. Let me explain what this is. The euro-dollar curve, this is on my fancy Bloomberg that I showed before you, basically shows what the market is pricing in at this very moment is the price to borrow money at many different points in time. And it shows you what the market thinks, or excuse me, what the market price is to borrow at these different periods at each one of those time periods. So let me explain this briefly. Basically, what I want to point out to you, there's a normal shape and there's a shape that's different, okay, which is the shape we have now, which is what we want to talk about, because the euro dollar market is pricing something that's kind of unusual. So first, let's talk about what the shape ought to look like. The shape of the euro dollar curve ought to kind of look like this, which is downward sloping, to the right. It starts up high, which means in this instance, it displays the price of money closer in, nearby. And then the farther it goes out, it shows what the market believes the price of money is going to be in the future. So this green shows the way the market was pricing this a year ago. That was basically 1% or so, much less than that on the short end, becoming close to 2.5% on the back. And you can display that in terms of the numbers on the right, where it says in this instance it's 97.6. That's 1.4%. You get the interest rate by taking 100, you're taking that out. So anyway, don't get lost in that. Here's the point I want to make you, is this is the shape of this curve right now. And this quick decline in it basically is reflecting very rapid interest rate hikes as the Fed is guiding for a very aggressive pace of hikes. The market has already priced this in. What is interesting, and what I want to talk about, is this thing right here. Basically, with the euro dollar kind of kinking back up, you can see this is a very different slope than, say, a normal curve. And so basically what the market is pricing in right now as a fact is that, yes, interest rates are going to rise pretty quickly on a peak at about 30.75%. in December, and then the market is actually pricing in rate cuts. That's what this rising price is. Now, that's not what anybody is really forecasting or guiding to from the Fed, so we need to talk about that, okay? The other thing I want to highlight for you is that there have been other periods in time that showed this same strange set of circumstances in terms of this kink in the euro-dollar curve. This shows 1989, when you can see interest rates were rising and then being cut. This is the market's forecast of what would happen. That did precede the 1990 recession. This shows the period in mid-2000, which was the height of the internet bubble. There had been a peak, a period of very rapidly rising rates. And then there was a little bit of an inversion. Of course, that did a pretty good job of calling the peak in the 2000 internet bubble. This shows 2018, November 2018, October 2018, where basically, again, there had been a period of rapid rate hikes, and you can see there was this kind of kink in the curve, which was the market's way of saying that it was betting, actually pricing into the market, that there would be lower rates in the future than people were expecting. So that's kind of highly anomalous. So the final thing I want to do here is just to outline, we went back and we looked over time to see what, those analogous periods I outlined. And this is what we wanted to show you. There were basically 3, not including this time. And the way we picked these is we looked at 2 factors. The first was the spread between the 10-year yield minus the 30-year yield. That was in white. And we show each of these instances in red. And then the yellow line, which is something we watch quite a bit, which is the relative performance of the investment grade total return bonds divided by the high yield of, the total return of high yield bonds. So the 3 prior instances that we have that we demonstrated for you, 1989, 2000, 2018, and of course now, we thought were interesting for 2 reasons. The first was that those marked periods where investment grade bonds began to outperform high yield bonds, which means credit problems started to arise. And then you had this kind of very high level in the spread of the 10-year and the 30-year start to decline. So what we wanted to demonstrate is in each of these instances, it was a good time to own higher quality, longer dated bonds. We think this is another one of those instances. We do believe that the euro-dollar market in its unusual shape is forecasting that, frankly, the Fed is making an error in raising rates too much. We think it's a good time to be defensively positioned, and that is exactly how we are. So be safe out there, everybody. It's a messed up market.